Welcome to Econverse. All right, today we're going to tackle one of those questions that almost every investor runs into at some point, and it can be a really tough one. It's this classic showdown between two totally different ways of thinking. So let's just dive right in.
Okay, so picture this. You get a bonus from work. Or maybe an inheritance comes through. Or, hey, you just sold your house. Whatever it is, you're suddenly sitting on a pretty big pile of cash. And boom, the question hits you like a ton of bricks. What do you do with it? Do you go all in, invest it all right now? Or do you kind of ease into it, spread it out over time?
And look, this isn't some rare niche problem, right? This is something that happens to people all the time. Doesn't matter if it's a small bonus or a truly life-changing amount of money. The fundamental question, it's exactly the same.
And let's be real here for a second. What's really at the heart of this whole dilemma? It's fear. It's that little voice in the back of your head whispering, what if I invest all of this money and then bam, the market crashes tomorrow? That fear of picking the absolute worst time to invest, man, it can be paralyzing. It stops a lot of people dead in their tracks.
So to deal with this fear, two main strategies have really come to the forefront, and they represent two completely different ways of looking at risk and opportunity when it comes to the market. Okay, first up, you've got lump sum investing. This one is pretty much what it sounds like. It's the direct approach. You get the money, you invest the money, period. The whole idea is to get your capital into the market and working for you for as long as possible. We're talking maximum time in the market. It really is like standing at the edge of a swimming pool and just cannonballing right in.
Then you've got the other side of the coin, dollar cost averaging, or DCA for short. Now with this one, you take that big pile of cash and you slice it up into smaller, equal chunks. Then you invest those chunks at regular intervals, maybe every month for say 6 months or a year. It's a much more cautious way to do it. Think of it like wading into the pool, right? You go step by step, letting yourself get used to the water.
So, at the end of the day, it's all about a trade-off, isn't it? With a lump sum, you're maximizing your time in the market, which, as we'll see, usually gives you the highest potential return. But, and it's a big but, you're also taking on all the risk at once. If the market tanks right after you invest, you feel the whole thing. Now, dollar cost averaging, that's all about managing that risk. It averages out your entry price. You end up buying more shares when prices are down, fewer when they're up. But the flip side is, while you're doing that, some of your cash is just sitting there, on the sidelines, potentially missing out on a rising market. Okay, so we could sit here and debate the philosophies behind these two all day long. But what happens when we stop talking and actually look at the numbers? What does the historical data have to say? Well, it turns out the story is surprisingly clear. So a really big study from Vanguard looked at this, and what they found is pretty staggering. Historically, lump sum investing has beaten dollar cost averaging about 68% of the time. So roughly 2/3 of the time, you would have been better off just putting it all in at once. And the reason is pretty simple, actually. Over the long haul, markets tend to go up. So any day your money is not in the market is a day you're likely missing out on potential growth. But what does that 68% actually look like in, real money? Let's put some dollars to it. So using that same Vanguard data, let's say you invested 100 grand into a standard 60-40 portfolio. After 1 year, on average, the lump sum approach would have turned that into about $109,360. Not bad. The DCA strategy, that would have grown to about $107,453. So that's a difference of almost $2,000. That's basically the price you pay, on average, for keeping some of your money out of the market for a few months. Now you might be thinking, okay, but is that just a US thing? Does this hold up in other countries? And that is an excellent question. The answer is a huge yes. This isn't just an American phenomenon at all. Researchers have crunched the numbers all over the world. And this table just drives that point home. I mean, look at this. Whether you're in the UK, Canada, Europe, Australia, the results are just unbelievably consistent. Lump sum comes out on top about 2/3 of the time, no matter where you are. This tells us it's not some random fluke. It's a really solid principle that's tied to how markets generally behave over time. Okay, so this brings up a massive question, right? If the data is this clear-cut, why is dollar cost averaging still so popular? I mean, why are we even having this conversation? Well, the answer has almost nothing to do with math and spreadsheets and everything to do with human psychology.
This really is the heart of the puzzle. You've got all this data pointing one way, but you have tons of investors and even a lot of financial advisors who swear by the other strategy, the one that the numbers say is likely to leave money on the table. So, what gives?
The key idea here is a little thing called loss aversion. It's a concept from behavioral psychology, and it's super powerful. Basically, for most of us, the pain of losing $100 feels about twice as bad as the pleasure of gaining $100. We are literally hardwired to hate losing more than we love winning.
And this quote here from a regular investor on Reddit just nails it. They said DCA helps them avoid that fear of buying at the top. And that's exactly it. DCA isn't really a financial optimization tool. It's an emotional management tool. It's designed to protect you from one very specific, very painful feeling: the regret of putting all your money in right before a big drop.
So a great way to think about it is like this. Dollar cost averaging is basically emotional insurance. And just like any insurance, you have to pay a premium. That premium is the slightly lower average return you can expect over time. And what are you buying with that premium? You're buying peace of mind. You're buying protection from that gut-wrenching feeling of regret.
All right, so where does that leave you? With your windfall, how are you supposed to choose a path when the cold hard numbers point one way, but your human emotions are pulling you in a totally different direction? Let's try to build a simple framework to help you decide.
Honestly, this choice boils down to knowing yourself. If you're the kind of person whose #1 priority is maximizing your long-term returns, and you know you can handle seeing your portfolio take a big hit without freaking out, then the data says lump sum is probably for you. But, and be honest with yourself, if you know that seeing a big drop right away would cause you a ton of stress, maybe even make you sell at the worst possible time, then dollar cost averaging is the smarter choice for you. Why? Because it keeps you invested.
So here's a simple 3-step way to think about it. Step 1, acknowledge the data. Just accept that on paper, lump sum usually wins. Step 2, assess your own gut. Ask yourself, how would I really feel if I invested this money and it dropped 20% next week? Be brutally honest. And finally, step 3, choose the path you can actually stick with. Because at the end of the day, the best financial plan is the one you don't give up on. Ultimately, this whole debate is such a fascinating clash between math and human nature, isn't it? The numbers, they tell one story, but our emotions, they often tell a completely different one. So the final question is really for you to answer. Which one is going to be the right guide for your journey?